There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
See what's going on here in equity land. I would encourage you guys, since this would be a short blast today, going to go through my recent blog post with you guys, see if maybe there's something that I can revise. I'm actually going to be presenting this, so it'll be a good walkthrough. You guys will sort of be my test to give me any feedback on this that you may have. But in any case, so here we are, unable to break. Actually, make the screen a little bit bigger here. There we go. So looking at the S&P from the standpoint of full screen, hopefully you guys can see this. Those of you trading index-based stuff on MT4, MT5, we have been unable to break the bottom. Actually had a big reversal off this with a large volume day. That usually tells us that you're going to see a couple of days of trading above this range. It's not necessarily going to right back and revert down. This is a big up day. Yesterday was a pretty good up day as well, and today looking like, I don't know, maybe an island reversal. That's where you gap way up or gap way down outside of a known range, right? Or a diagrammable range, and then you come right back into it. It's actually a really bearish signal. But what I'm reading, at least in the market, is that X amount of big players didn't want to see this go down. Now, here's where the conspiracy theory that I dived into a bit on Saturday comes into play, is we just don't know these players. We don't know the extent of these players. So many of these players are big banks, mutual fund companies, over-leveraged hedge funds, sovereign wealth funds. And then there's that conspiracy theory part that says that it's probably the Federal Reserve, but we just don't know, right? So just keep that in mind as you're going through your trading. I think for now we're stuck in a range, unless some other hammer drops, good or bad, really. Let's take a look at NASDAQ. It's kind of the same thing. Had a pretty big reversal today. So futures were up huge this morning. Move into the dollar. I still continue to see, as I talked about Saturday, high just under 115, low essentially 110. Us spending time in this range, so it opens up opportunity for two-way trade. The euro, US dollar, same thing. For lack of a better, it's going to be stuck inside of a range. Let's see, so we had the big flex off the bottom from the British pound, and I would imagine this range is going to be capped somewhere around right here. I think trading sideways for it. So also of note, GBP CAD right here, we broke above this parent, now we've had potentially better policies play out in Britain, and hence, a big rip off the bottom. I still think this is an unfinished auction. Obviously, this is really far away, right? We're looking at daily charts. So, but look how fast we made it to that point. I mean, what if some of the decisions they made decide they don't get implemented? What if they get reversed, right? We could certainly get down to the bottom there as well. Take a quick look at gold, holding on the edge. It's always amazing to me, stuff's just holding on the edge. Oil going back down to that 76 area, I would imagine. Almost like everything's almost like it's in a holding pattern, I'm gonna look at the coin. I talked a lot about this on Saturday. Kind of a messy chart, but if you look at a weekly on this, you can see how we're holding. I mean, it's almost like everybody's in just a holding pattern. We're like circling above the airport waiting for further instructions on to land or to do what. And that's pretty much all I have as far as the markets and so forth. Take a look at the news events I had mentioned this week. CPI, and as you can see, it came in hotter. Now, obviously, this is just New Zealand, but still, right? Developed market, so it can play out. But I'm going to definitely want to see this number tomorrow. This is a big one, guys. Don't be trading in front of these red folder events. Most of these are coming out at 8:30. Do keep in mind that this is East Coast time you're looking at, right? So always adjust these times for whatever zone you're in. And actually, one other thing. All right, tell you what. Do you guys a little favor here. I'm gonna read you this blog. I kind of need to practice this anyway. So for those of you that don't watch the screen when I'm talking, this will serve you. So this blog I entitled "A Walk Down a Dangerous Fed-Induced Memory Lane," which is a bit much as far as the title. But I didn't know how else to word this, and not being a writer, there you have it. So I'd like to tell you a tale that might teach us all a lesson or two about what's coming. A walk down memory lane, if you will. As many of you know, the 70s were characterized by deeply negative real interest rates as well as rampant inflation rates. Borrowing boomed both public and private, so did asset bubbles. Because the financialization of the economy had not yet benefited from deregulation, asset bubbles were more localized. So farmland in places like Nebraska and Kansas, and oil-rich land in places like Oklahoma and Texas, and they in mineral rights, as used as essentially as bank collateral, but land prices rising led to more valuable collaterals that led to more borrowing, that led to the you sort of know what. So at the time, oil rigs were booming in the same way, so investments going through the roof on cheap borrowing, mineral leases, energy loans, you name it. I actually know this for a fact because as a child, my mother's sister's husband, Frank, owned a company called West Texas Pipe and Steel. And he was just absolutely killing it in his business. I mean, they bought an awesome ranch in Texas. Every time he showed up at like family events, he'd always, and I remember this as a kid, I was probably, 13, 14 years old, but man, Uncle Frank, he just came rolling in with brand new Cadillacs and Mercedes, and I was always like, hey, Dad, what's this guy do? And he's like, hey, he sells pipe to oil rigs in Texas. I'm like, no kidding. So kind of thinking I was in the wrong gig, right? But in any case, I always thought that was a cool story. But you guys all know how this ended. So essentially, the Volcker doubled the federal funds rate to break the psychological vicious cycle of price and asset inflation, right? So this is Paul Volcker. So the need to shock and awe was the result of years of negative real interest rates as the Fed stood by and idly watch the economy split in price asset bubble frenzy, okay? So Volcker succeeded, as you know, and inflation was brought back under control, but farmland prices crashed by almost 30%, and oil went from 120 a barrel to 25 over a few years. And as a result, 1,600 banks collapsed in the aftermath of this asset bubble popping. Okay, so just so you are clear, you're thinking, it's not that big of a deal. To put this number in perspective, so the global financial crisis, right, saw, and that's just, we use the acronym GFC around here on that, saw a total of less than 400 U.S. banks collapse over 2008 to 13 versus 1,600 back then, right? So as asset prices collapse, banks collapse, there's a contraction of credit, and the unemployment rate hit 10%. So if you break down the mechanisms at play, the Fed enabled and encouraged lending growth, animal spirits led to unbridled speculation on the value of assets, right? Think about that oil pipe story, right? Banks played their role in facilitating the self-reinforcing nature of this speculation. Then the music stopped. So leveraged players got wiped out, late buyers got wiped out, collateral value collapsed, banks went bust. So all throughout that inflationary asset bubble cycle, there was a prevalent school of thought that blamed inflation on supply cost push, right? How familiar does that sound? You're hearing all that crap coming out, right? Lots of organizations got blamed. Unions for fueling wage price spirals, Middle Eastern oil cartels for juicing up oil prices, right? Price and wage controls were imposed and then failed. Sounds familiar, right? But the Fed's own research advanced an explanation based around the notion of monetary policy neglect, which refers to this sort of obstinate policy of negative interest rates in the face of evidence of excessive lending and demand fueled by price pressure. So the same thing you're hearing coming out of most of the financial media right now. All this sounds very familiar because everybody's using this as the same excuse as to what's going on, especially the administrations at the time and today. So this gets us essentially, where are we? Are there any similarities in the way that the Fed has conducted monetary policy during this bout of inflationary burst, right? The Fed's using the same policy tool as they did in the 70s. So by maintaining large negative real rates in the face of a shift in the fiscal paradigm and negative real rates with essentially trillions spent directly on stoking demand, right? Totally including mistimed tax cuts. But that's not all. I mean, this time the Fed introduced a new policy since the GFC and the big oil crisis, and that's called quantitative easing. You guys have heard me talk a million times about QE, right? So it did many rounds of it, but then it went unhinged in 20 with the COVID shock. You can argue in 21 as well, right? So while QA is unambiguously not directly inflationary, it does have an incidence of persistence of inflation. So if I were to lay out very simply, it would look like this. QE has had a very powerful signaling effect. You have the largest player in the market with unlimited buy-selling opportunity with an unholy amount of a certain asset, right? Primarily bonds. So that signals that the price of such assets will be supported well into the future. So as it happens, that price is the reverse of the cost of capital. So as a result, and given the absolute certainty that this cost will be kept under control into the foreseeable future, what does any rational economic player do? I mean, the answer is they load up on debt and buy assets, right? So if you load up on debt and you spend as if you were a government, and so debt, essentially corporate plus sovereign, went into the stratosphere. This did fuel an asset bubble as many channels directed proceeds of leverage into assets, right? Buybacks are an example. It's buybacks of stock, okay? So leveraged loans, another, right? Margin loans in your brokerage account, right? That's another one. Mortgages, you name it, right? These are all different levels of leverage. So enter inflation. We did specify that the Fed went ballistic just as demand side was being stoked by unholy spending, as I'd mentioned, right? So there are clearly elements of monetary policy neglect at play. Anyway, so entering inflation when sovereign and corporate debt has increased a lot is not good. So take your pick whether you want to measure an absolute or as a percentage of GDP or whatever, but corporate and sovereign debt increased a bunch. And so comes a time when inflation is rising fast and rational economic player will develop serious doubts as to the system's collective ability to repay all of this debt. So it starts making sense to dump all of this load of debt and then buy more assets, essentially like resources, like physical, energy, consumer, more. This is a point when the pile of negative yielding debt contracts massively. That tipping point is essentially now. So debt will continue to be sold until it's reached a level that is deemed unsustainable, right? Fed's awakening after slumber, it's been the last 12 years, if you will only reinforce this dynamic. That's a long way from here. Now, will that lead to a pop in various asset bubbles? I can't say. For certain, I should say. I can't say for certain. But most that follow this theory of thinking, they believe it does, right? Or they will pop. We're certainly seeing that now in stock markets, obviously, with a 25% plus decline. So will we see bank failures? More than likely, yes. But there are obvious differences. Mostly, bank lending was far from unbridled this time around, right? Think about the bank lending that took place, during '08 and ghost properties, and essentially then all of the much more fragmented banking industry that was the case back in the early '80s. But essentially there are obvious differences, right? So banks are in a better reserve and regulatory place that they've been in a while. And that can be credited again to Volcker and that Fed corollary, where a lot of the dirty work got lifted by a swath of shadow banks that are less regulated. So in return, these get financed by traditional banks, but not through traditional loans. So if you think Argos blowing up, they did cost a lot of money to the banks. So the last difference is that current bubble proportions are biblical as financial markets got infinitely more complex and interconnected, with lots of illiquidity and counterparty risks built in. Okay, so, and this is where you've probably seen this a lot on financial media, where talking about the size of debt right now is much, much larger. That's the sort of unknown piece that, hell, I could probably write another 4 pages on this, but I don't want to bore everybody to death. I want to kind of get to the understanding of what's going on. So lastly, the difference is that in most of this stuff, the naysayers of the memory lane reflection will say, well, the Fed's doing it a little bit differently this time. There was no period of time in the 70s where there was quantitative easing by the Federal Reserve Bank before all this inflationary stuff hit. No, that's true, right? Will that soften the blow? I have no clue. So, but as I always mention on my podcasts and in presentations, I could be wrong. But I feel that essentially a walk down sort of this memory lane could be quite brutal this time around. So seek safe assets to protect your wealth. And I will wish everybody a great trading week. This will be up on our website, firstdownfinancialinc.com, in a couple of days. May the trades be with you.